So here's a 2026 survival guide. This is what you do when rates stay high for a period of time. Look, there's definitely some investors out there that are looking at 2026 and they're waiting for rates to come back down to 2% before they make their next move. Well, not only are you wasting your time, you're also wasting your opportunities as well. Look, it's no doubt being a property investor in 2026 is a hell of a lot harder than what it was in 2021. In 2021, when rates are at 2%, everyone looks like a genius. Property prices are shooting up, everything's cash flow positive. But 2026, we're starting to see now where investors are getting fatigued, right? Rates have been high for quite some period of time. They're not sure whether it's going to ease up. And on top of that, they've just been dealt a blow in terms of the federal budget. So everyone's looking for what to do now. Their Instagram feeds are full of other alternatives, usually to deal with borrowing companies or buying new property. But for the average person, this is just a bit too far. So here are some very basic tips to help you survive in 2026 and the things that I encourage all clients to be doing and considering. Now, in 2026, everyone's major constraint is the same thing, and that is serviceability. Your ability to pay has replaced investors' number one constraint. The number one constraint used to be people not having enough equity to then go and facilitate another purchase. But everyone's got equity nowadays, but no one has serviceability. Why don't you have serviceability? You don't have serviceability because rates are so high. Why are rates so high? It's because of sticky inflation. Why do we have sticky inflation? It's because of government spending, and the circle goes. So we know government spending and inflation is not going away anytime soon. We know that rates are going to be quite high for the foreseeable future. At least the next 18 months, we expect to be in this kind of higher rate environment. So what are people doing? What is the average investor doing, and what are they considering? Now, there's three key things that I would encourage every investor to do in this set of circumstances. Number one is decoupling, right? Decross-securitizing your portfolio. Having cross-securitized properties is fine when you're trying to obtain the next property. Maybe it was a lender requirement at the time, but when you are in a situation like this and you know that you might need to have the different value or extract equity at different times from different properties, it's best to have them standalone. So the number one thing is make all your properties now standalone facilities, decouple them, uncross-secure them, and have each property with its own set of loans against it. If that's all with the one lender, great, but if it turns out there needs to be with two or three, well, that's still fine as well. I'll show you why this is a little bit more important as we move through the next steps. Now, if you're still unsure about what is cross-securitization, I've got a whole other video on that, and I'll put the link below. Now, step number two is think in terms of cash flow. If rates went to 9% tomorrow, do you want your debts at 9% on principal and interest, or do you want them at 9% on interest only? Now, from a cash flow point of view, I know what I want, and I want them at 9% on interest only. There's another key reason that smart investors move their loans when they're at higher rates to interest only. And that is because if you've got cash that you can put in offset, your monthly interest cost and your monthly repayment, and therefore the thing that cash flow is calculated off, is based on the balance of what you owe on the loan and what's in the offset account. So if you've got a $900,000 loan and you've got $200,000 in the offset, your interest only payment is based on the $700 as opposed to the principal and interest payment based on the $900, even though you've got $200 in offset. So moving into having more of your loans on interest only, or a standalone facility with the ability to have cash in offset, is definitely the thing that's going to help you from a cash flow point of view. And remember, cash flow is the thing that helps you own your properties for longer. You only need to sell a property when you run out of cash. If you've got unlimited cash because you've managed your cash flow right, then you're never in a situation where you're forced to sell any of your assets. And look, the third thing to think of is the second tier lender advantage. Now, only then, if you decide to cherry pick one of those properties to get the equity out of, and you take that loan to a second tier lender, then they will be able to refinance that property because they'll be able to do so, but also they will be using in their calculation the actual repayments for the other loans that you have on the interest-only payments, not on their debt limits, not on an increased buffer, not on their servicing calculation, but based on the actual repayments for those interest-only loans. This equation fuels the fire to be able to give you larger equity releases against your assets, and then larger purchasing limits for the purchase of new properties. Considering after you've done the other two bits of homework using a second tier lender in order to do your equity release and your purchase is the thing that can fuel your property acquisitions in times of high interest rates. Now, this term is referred to as lender sequencing, whereas we use deposit-taking institutions and then non-deposit-taking institutions to fuel our portfolio. If you'd like to know more on this, I have a whole video on it and the link is also below. Once you've completed steps 1, 2, and 3, then you can think about being ready to go and make your next purchase. And why is it important to be ready? Well, number one, no one else is ready. I can assure you of that. I talk to clients every day that are just in a very stuck situation because they haven't done the homework. But if you have done the homework, then you can look for the opportunity. And what is the opportunity? The opportunity is that because of all of the CGT changes and the changes in regards to the federal budget, there will be a lot of investors and a lot of sellers looking to settle up before June 2027 and get out altogether. Now, if I was cashed up and I had my equity release done and I had my pre-approval done, it's now an ideal time to buy and look to purchase a property. And there'll be plenty of properties to purchase and at the right money over the next kind of 6 to 12 months. In a high interest rate environment such as this, it's always counterintuitive and counter-cyclical to get out there and want to try and get more debt and purchase property. But this is actually the time when you can go against the grain and have great success. Remember, you're not trying to buy a property to sell it in 6 months' time. Whatever you buy now in 2026, 2027 are the assets that you will be selling come 2037, 2040. It's a long way down the track when you're thinking about disposing of what you're going to buy right now. So if you follow my advice, you'll come up with a bit of a 90-day action plan. And in my 90-day action plan, I'd be doing the following. Number one, look at your current portfolio. Think about what would happen if rates went to 9%. Which loans would you want on interest only? Which loans would you want on principal and interest? This will help you stress test your portfolio and work out which loans need to be refinanced or renegotiated. That leads me to my next bit. The loans that are going to stay where they are and we're going to renegotiate, get on the phone to those lenders, see if we can get a better deal, put in our pricing requests, let's get those rates to come down as much as possible. Obviously, cash flow is king. The less money we have to pay to a bank, the better. Finally, I would also consider commercial as an option. Now, with the recent changes, obviously residential property established is not looking as attractive as what it was before. But I tell you what, good, well-chosen commercial properties in the right area with the right rental return, with the right tenant and leases in place, have always been attractive. They do go a little bit soft when rates go a little bit high. There's a reason for that. Now, a good commercial property usually would have about a net 6.5% return. If you're going to pay 7% commercial, kind of loses its shine. But these properties are out there, they do exist, they're very long-term buy and holds. These are the type of things that you might pick up now, just a little bit on the cheaper side. When rates come down and you start to pay 5.5% on your commercial loan and you're starting to look at getting 7% net return on your commercial lease, then these properties are going to look pretty attractive once more. Once again, long period of time, 10 or 15 years, re-sign leases, rental increases. There is plenty of good news about purchasing a commercial property in the current market. So if you found this information useful, but you want someone to help and step you through it, please, by all means, reach out. I'm happy to have a chat with you about your current portfolio, what your debts are, what your liabilities are, what your assets are, where I think your portfolio can go. I'm more than happy to spend some time and talk you through it. If you found this information useful, please, as always, like and subscribe to our channel.